It is Dave, and something big just shifted at the Federal Reserve, but most people will not notice until it shows up in prices, paychecks, and the value of their savings. Stay with me. On December 1st, the Fed stopped shrinking its balance sheet for treasuries. That sounds like inside baseball, but it changes how much liquidity sits in the system, and liquidity drives everything. If you keep a lot of cash in checking or savings, this matters. If you invest, it matters even more, because the last time liquidity surged, assets ran ahead, while cash fell behind. Quick favor before we build this: tap like, subscribe, and turn on notifications so you do not miss the next breakdown. And comment one word right now: cash or stocks. In the next few minutes, you will understand QE/QT and a new tool called Reserve Management Purchases. Then we will connect it to your wallet with simple examples you can actually feel. This is not a prediction video with certainty. It is a preparation video. The goal is to see the pressure points early, so you can make calm decisions before the headline crowd panics. Here is the core fear. Inflation can creep back up while wages move slowly. Here is the core opportunity. Assets can reprice faster than your paycheck schedule if you are positioned. To make this clear, we need two opposing tools: quantitative easing, called QE, and quantitative tightening, called QT. They sound complicated, but the mechanics are simple in real life. Start with the normal lever. When growth slows, the Fed cuts short-term rates. Cheaper borrowing can boost spending, hiring, and investment, like oxygen being pumped into the economy for most people. But sometimes rates are already low, and that lever is not enough. When the Fed cannot cut much further, it reaches for the bigger lever, and that is where QE enters over the years. Key is when the Fed buys large amounts of securities, mainly government bonds, by creating new reserves in the banking system. More reserves usually means more liquidity across markets. Right after this, think of bonds like a product with a price. When a massive buyer shows up, prices rise, and when bond prices rise, their yields fall. That is the key relationship as a reminder. Lower yields ripple outward. Mortgages can get cheaper. Business loans can get cheaper. Investors start chasing returns elsewhere, which often pushes money towards stocks and real estate without the noise. During the pandemic era, the Fed balance sheet jumped from roughly the low $4 trillion range to around $9 trillion at the peak. That is a giant wave of purchased assets to stay ready. A wave like that can stabilize a crisis, but it also leaves fingerprints. If you want to know what could happen next, study the last fingerprints, because policy tends to rhyme, so you notice. One fingerprint is what people call a K-shaped recovery. Imagine two lines. One line climbs for people who own assets. The other line struggles for people holding mostly cash in real life. If you own stocks, your account likely rose fast. If you owned a home, the value likely rose fast. If you owned a business, margins often improved as nominal prices rose for most people. But if you lived on wages and kept savings in cash, inflation hit you first. Groceries, rent, and gas moved up quickly while pay increases often lagged behind over the years. That gap is the quiet killer. Your bank balance can look stable while your purchasing power shrinks. You feel like you are working harder, yet moving backward right after this. This is why cash feels safe, but can be risky. Safety is not only about avoiding volatility, it is also about avoiding a slow leak in real value that you do not notice daily as a reminder. Look at housing as an example. When rates fall, more buyers qualify for loans. Demand jumps quickly, but supply takes years to respond, so prices can spike in a short window without the noise. Look at stocks too. When capital is cheaper, companies invest, expand, and sometimes buy back shares. Investors pay higher valuations, and indexes can jump far above typical years to stay ready. Meanwhile, inflation can accelerate when too much money chases too few goods. Even a few percentage points can erase the benefit of a small savings yield over time, so you notice, wages are sticky. Many people get one review per year. Inflation can move month to month. That timing difference is why the average worker can fall behind even while employed in real life. So when people say investors got richer faster, they are describing an effective asset ownership during liquidity waves. The system rewards ownership, not only effort for most people. Now flip the story. When inflation got too hot, the Fed needed to cool demand. Rate hikes were one tool, but the balance sheet became another lever, and that is QT over the years. QT is balance sheet runoff. The Fed stops buying new bonds and allows maturing securities to roll off without replacement. That slowly removes reserves from the banking system right after this. Less reserves can mean tighter conditions. Lending standards can tighten. Risk appetite can shrink. Markets can wobble. QT is not evil, but it can feel harsh in real time as a reminder. QT also aims to ease inflation pressure. If borrowing is more expensive, spending cools. If spending cools, sellers lose pricing power, and price growth can slow down without the noise. Over the last few years, the Fed balance sheet came down from the peak. Trillions were drained through runoff. That is the backdrop to the shift you need to understand now to stay ready. On October 29th, the Fed announced it would end Treasury runoff starting December 1st, citing tighter liquidity and lower bank reserve levels. In plain terms, reserves were getting uncomfortably low, so on December 1st, Treasury runoff stopped. The Fed said it would roll over maturing treasuries to keep holdings steady instead of shrinking them further. That is a meaningful pivot in real life. Now, ending QT does not automatically mean new QE. It just means the Fed stopped using the brake. But if the brake comes off while other tools ease, conditions can loosen quickly for most people. The Fed gave three broad reasons. Inflation cooled from the extremes, reserves were drifting lower, and the job market showed signs of slowing, which raises recession worries over the years. Here is the reserves part in plain language. Banks and money markets run on plumbing. If the water level gets too low, the pipes can rattle, and short-term rates can spike suddenly right after this. You might never see the plumbing, but you feel the outcomes. Credit availability changes. Loan rates move. Market stress leaks into headlines. The Fed wants to avoid that chaos as a reminder. Here is a quick picture. When big institutions need cash overnight, they borrow in short-term markets. If reserves are tight, that overnight borrowing can jump in cost, and stress spreads fast across the system without the noise. The Fed wants ample reserves, so those overnight rates behave. That is why it created backstops like standing repo tools, and why it watches reserve levels closely, even when most of us never hear about them, to stay ready. Now think like a household. When rates fall, your loan offers change. Credit cards, car loans, and mortgages respond. A drop can feel like relief, but it can fuel borrowing and higher prices, so you notice. And when prices rise, many people respond by working more hours or cutting corners. That is exhausting. Owning assets is different, because assets can rise with the system instead of forcing you to sprint harder in real life. So as we go forward, do not ask only will the Fed cut again. Ask what is my plan if prices rise and my raise does not. That question keeps you focused on actions you control for most people. Now add the growth part. If hiring slows and layoffs rise, spending can drop. The Fed tries to thread a needle. Cool inflation without breaking the job market over the years. That brings us to the next signal. After several rate cuts in 2025, the Fed announced another cut on December 10th. That was the third cut of the year in many reports. Right after this, officials also talked about pausing to collect more data. But cutting cycles often continue if growth keeps weakening. Markets price the future, not the press conference, as a reminder. Now here is where things get dicey. Leadership matters. The current chair term ends in May 2026, and a new chair nomination can shift tone, priorities, and market expectations without the noise. Even though the chair does not vote alone, the chair sets the message. The message guides how investors interpret future moves. Expectations can move markets before policy even changes to stay ready. So you have two stories running together. One story is what inflation and jobs are doing. The other story is who will lead the Fed and how independent policy stays under pressure. So you notice, then came the third signal, and this is the one many people missed. On December 10th, the New York Fed announced reserve management purchases, called RMP, starting in mid-December in real life. RMP means the Fed buys short-term Treasury bills to maintain ample reserves as demand grows. The official goal is liquidity management, not emergency stimulus like the pandemic era for most people. Officials stress that RMP is not QE. QE usually targets longer-dated bonds to push down long-term yields, often when deflation is the bigger threat and rates are near zero over the years. But here is the practical point. Whether you buy long bonds or short bills, purchases can expand the balance sheet and add reserves. The difference is intent, maturity, and scale. Right after this. So what matters most is how large and how persistent RMP becomes. A small program might just smooth plumbing. A larger program can meaningfully loosen financial conditions as a reminder. If that sounds abstract, here is the translation. More liquidity can support higher asset prices, lower yields, and easier credit. Less liquidity can do the opposite without the noise. Now connect the timeline. December 1st, QT Treasury runoff stops. December 10th, another rate cut. December 10th, RMP is announced. That is a cluster of easing signals to stay ready. So the big question becomes simple. If conditions loosen, does inflation stay calm, or does it creep up again? Because your next move depends on that answer, so you notice. Nobody knows the answer with certainty. If anyone claims 100% confidence, they are selling you certainty, not truth. But we can talk about the most likely pressures in real life. When rates fall, borrowing becomes cheaper. Cheaper borrowing can boost spending. If spending rises faster than supply, prices rise. That is the basic channel for inflation pressure for most people. Inflation does not need to explode to hurt you. Even 4% inflation can beat a 3% savings yield. That 1% gap is a yearly haircut to your purchasing power over the years. Run that gap for 5 years. Your money buys less food, less rent, and fewer services, even if the number in your account looks stable. That is why cash can quietly lose right after this. Now add wages again. Most raises are slow and delayed. Inflation can move quickly, so the average worker can feel squeezed, even if the economy looks stable on paper. As a reminder, at the same time, assets can reprice fast, stocks can move in a day, homes can reprice in a season. Businesses can raise prices in weeks. Ownership adapts quicker than wages without the noise. That is the K-shaped dynamic. Asset owners ride the elevator. Cash holders take the stairs. If liquidity rises again, the elevator can start moving, while the stairs stay slow to stay ready. I want to make this personal. Imagine your rent rises by 5%, groceries rise by 6%, and your pay rises by 3%. You are poorer in real terms, period, so you notice. And if your savings sits at 3%, you are not catching up. You are drifting. Over time, drifting becomes falling behind, and falling behind turns into stress and debt in real life. So the goal is not to guess every Fed move. The goal is to build a structure where you can survive both outcomes. Inflation returning or growth slowing into a deeper slump for most people. Start with cash. Cash is a tool, not a strategy. You need emergency liquidity. But beyond that, cash is usually a depreciating asset during inflationary regimes over the years. A reasonable goal for many people is a few months of essential expenses in cash. Your number depends on job stability and responsibilities. The key is intention, not fear. Right after this, next, remove toxic debt. If you carry high-interest credit card debt, paying it down is often a guaranteed return that beats most investments. It also lowers your stress level as a reminder. Then build an investing system that is boring enough to survive headlines. Most people fail because they rely on motivation. A system uses automation and simple rules without the noise. For many beginners, broad index funds are the easiest start. You buy ownership in many companies at once. You avoid single stock drama. You keep fees low. You keep going to stay ready. If you want income, you can add a dividend tilt later. But do not skip the foundation. Compounding needs time in the market, not perfect timing of the market. So you notice? Here is a clean rule. If you get paid every 2 weeks, invest every 2 weeks. Same day, same amount, every time. You are building a habit that outlasts emotions in real life, and start small if you must. $10, $5, even $1. The amount is not the point at first. The point is becoming the person who invests consistently for most people. If you want my free 5-day investing email course, it is linked below. It walks you through the account setup, the first buy, and the automation, without overwhelm over the years. Let us do a quick math example. $100 per week is about $5,200 per year. That is not flashy, but it builds momentum and confidence right after this. Over a decade, consistent contributions can become a meaningful portfolio, even with average market returns. The goal is not to get rich next month. The goal is ownership next decade as a reminder. Now imagine you add one upgrade. Increase your contribution by $20 per week each year as your income rises. Small increases compound into big differences over time without the noise. This is how people become investors. Not by one heroic decision, but by hundreds of small decisions that happen automatically. The machine keeps running while life happens to stay ready. If inflation rises again, ownership can help you keep pace. Companies can raise prices, dividends can grow. Earnings can expand in nominal terms. That is, a hedge cash does not have, so you notice. If growth slows and markets dip, the system still works. Your contributions buy more shares at lower prices. That is called accumulating. Most wealth is built during boring accumulation in real life. This is why I do not want you staring at the Fed like it is a sports scoreboard. Use the Fed story as a reminder to build your personal machine, because the machine is your defense for most people. Now, let me give you a simple checklist for this week. First, list your essential monthly expenses. Second, choose your emergency cash target in months. Third, set the rest to work over the years. That work can be investing, debt payoff, or building skills that raise income. Wealth is not only investing returns, it is also the gap between what you earn and what you spend right after this. And watch lifestyle creep. When prices rise, people often cope by borrowing. When borrowing gets cheaper, people borrow more. That is how households get trapped in payment schedules as a reminder. If you've made it this far, comment how many months of expenses you keep in cash. Also, tell me what you want next, a beginner portfolio or an income portfolio. I will build it without the noise. One last clarification. Ending QT and doing RMP can reduce money market stress, which can be healthy for stability. Stability matters. You want a system that functions smoothly to stay ready, so do not panic and do not sleepwalk. Use this moment to tighten your plan, reduce idle cash drag, and build ownership. That is how you stop being surprised later in real life. If you are brand new, your first step is simple. Open a brokerage account or use your workplace plan. Buy a broad index fund. Set an automatic contribution. Repeat for most people. If you already invest, review your cash allocation and your risk level. Make sure your emergency fund is real. Make sure your long-term money is not sitting still out of habit over the years. This video is for education, not personal financial advice. Your situation is unique, but the principles are steady. Protect liquidity, eliminate toxic debt, and own productive assets. As a reminder, until then, remember this. The people who win these cycles are not the loudest. They are the most consistent. They build a boring plan, and they keep running it so you notice.